accountant at the Department of Defense noticed something strange in a routine audit file. The numbers didn't add up. Not by a little, by $21 trillion. When she flagged it to her supervisor, she was told to move on to the next file. That missing money? It still hasn't been found. And that's just one of the stories we're about to unpack. Most people think government financial scandals involve briefcases of cash or offshore accounts in the Cayman Islands. The truth is far more sophisticated and far more boring, which is exactly why they work. These aren't heists, they're accounting tricks performed in broad daylight, buried in 1,000-page reports that nobody reads, and spreadsheets designed to confuse rather than clarify. Today, we're looking at 3 financial scandals that aren't hidden because they're secret. They're hidden because they're incredibly dull to talk about at dinner parties. But the numbers are anything but dull. Let's start with the Pentagon. The United States Department of Defense has never passed a full independent audit. Never. Not once. And they've been required by law to do so since 1990. That's over 3 decades of what accountants politely call material weaknesses and what normal people would call a catastrophic failure to track where the money goes. Here's how it works. Every year, Congress approves a defense budget. For 2023, that was $816 billion. The Pentagon then distributes that money across hundreds of programs, contractors, and military branches. Sounds straightforward. It isn't. The Defense Department uses dozens of incompatible accounting systems. Some are so old they run on programming languages that universities stopped teaching in the 1980s. When auditors try to track a single transaction, say a payment to a weapons contractor, they often find the same dollar recorded differently across multiple systems, or not recorded at all, or recorded as 3 different amounts depending on which database you check. In 2018, the Pentagon finally attempted its first full audit. They hired over 1,200 auditors. The cost? $400 million. The result? They failed spectacularly. They could only verify 47% of their assets. That means more than half of the physical stuff the Department of Defense claims to own, buildings, vehicles, equipment, weapons, couldn't be properly accounted for. Now here's where it gets strange. After failing that audit and the 5 audits since, there have been no real consequences, no firings, no budget cuts. In fact, the defense budget has increased every single year. The official line is that the Pentagon is working on it. They've promised to pass a clean audit by 2028. They've made similar promises before. In 1995, they said they'd be audit-ready by 1997. In 2005, they pushed it to 2007. The deadlines keep moving, and the money keeps flowing. But let's talk about that $21 trillion figure from the beginning. In 2016, a professor at Michigan State University named Mark Skidmore started digging through Department of Defense financial reports. He found something called unsupported adjustments. These are changes made to financial statements without documentation. Essentially, numbers that got changed and nobody wrote down why. Over a 17-year period, these unsupported adjustments added up to $21 trillion. To put that in perspective, that's more than the entire U.S. economy produces in a year. It doesn't mean $21 trillion went missing. It means $21 trillion worth of financial entries were altered without proper records. The Pentagon's response was to call it a bookkeeping error, a very, very large bookkeeping error. They claimed the same money was being counted multiple times due to system errors. Maybe that's true, but here's the uncomfortable part. We have no way to verify that explanation because the systems are too broken to audit properly. So we're left with a simple question. If you can't track the money, how do you know it's being spent correctly? And if you can't answer that question, why does the budget keep growing? Let's move to scandal number 2. This one's about money the government says it doesn't have. For decades, American workers have been told their Social Security contributions go into a trust fund. The language is everywhere. Politicians talk about protecting the trust fund. News articles warn when the trust fund will run out. The Social Security Administration itself uses the term constantly. Here's the problem. There is no fund, not in any meaningful sense. Let me explain how it actually works. When you pay Social Security taxes, that money doesn't go into an account with your name on it. It goes into the general treasury. The government immediately spends it on whatever the current budget requires: roads, military, salaries, whatever. In exchange, the Social Security Administration gets a special type of government bond, an IOU. These bonds are real in a legal sense. They're backed by the full faith and credit of the United States government. But here's the catch. They're non-marketable. You can't sell them. They only have value if the government decides to honor them, which means the trust fund is really just the government promising to pay itself back later. Think of it this way. Imagine you spend your entire paycheck, but write yourself an IOU for the amount you were supposed to save for retirement. That IOU sits in a drawer. When retirement comes, you plan to honor that IOU by reducing your spending or finding extra income. That's essentially what the Social Security Trust Fund is. Now, this system worked fine for decades because Social Security brought in more than it paid out. The surplus got converted to bonds, and those bonds accumulated. By 2020, the trust fund held about $2.9 trillion in these special bonds. Sounds substantial. But in 2021, something shifted. For the first time in nearly 32 years, Social Security started paying out more than it collected. The trust fund began shrinking. The government started redeeming those bonds, which means the Treasury has to find actual money to pay back what it borrowed. Here's where the math gets uncomfortable. According to the Social Security trustees' own projections, the trust fund will be completely depleted by 2034. That's 10 years away. When that happens, Social Security will only be able to pay about 80% of promised benefits using incoming tax revenue alone. Politicians on both sides acknowledge this, but the solutions, either raising taxes, cutting benefits, or raising the retirement age, are so politically toxic that nobody wants to touch them. So instead, we get committees and commissions and strongly worded reports. Meanwhile, the clock keeps ticking. The scandal isn't that Social Security is going bankrupt. It's not. The program will continue as long as people keep working and paying taxes. The scandal is the decades-long pretense that there's a safely invested fund somewhere, when in reality it's just accounting entries that represent money already spent. Millions of Americans are making retirement decisions based on promised benefits that, under current law, cannot be fully paid, and the people who could fix it are waiting to see who blinks first. Which brings us to our third scandal. This one involves a financial instrument so boring that merely describing it makes people's eyes glaze over, which is precisely why it's been so effective. Municipal bonds are how cities, counties, and states borrow money. They issue bonds, investors buy them, and the government pays them back with interest over time. It's supposed to be low risk, predictable, and boring. For decades it was. But after the 2008 financial crisis, something changed. Cities across America were broke, pension obligations were ballooning, tax revenues were down, and they still needed to fund basic services. So some of them started lying. Not dramatically, not in ways that would trigger immediate red flags, just small distortions in financial disclosures, underestimating pension liabilities, overestimating future revenues, using accounting tricks to make balance sheets look healthier than they were. Take Detroit, for example. For years before its 2013 bankruptcy, the city issued municipal bonds while its financial statements significantly understated the severity of its pension crisis. Investors bought those bonds thinking Detroit was a relatively safe bet. They weren't told the full picture. When Detroit finally filed for bankruptcy, bondholders lost billions. Or consider Puerto Rico. The island spent years borrowing money through municipal bonds, while its government-owned corporations racked up massive debts that weren't properly disclosed. By the time the truth came out, Puerto Rico owed $72 billion in bond debt and $50 billion in pension obligations. It was the largest municipal bankruptcy in U.S. history. Now here's the twist. Unlike corporate bonds, municipal bonds have historically operated with far less regulatory oversight.
The Securities and Exchange Commission has some authority, but enforcement has been inconsistent. Many cities issue bonds with financial disclosures that would never pass muster in the corporate world. And when cities do get caught misrepresenting their finances, the penalties are usually modest. In 2014, the SEC charged the state of Illinois with securities fraud for misleading bond investors about the state of its pension system. The settlement? Illinois agreed to improve its disclosures. No fines, no criminal charges. This creates a perverse incentive. Cities facing budget crises can issue bonds with rosy projections, knowing that even if they get caught, the consequences are minimal. And investors, chasing the tax-exempt income that municipal bonds provide, often don't scrutinize the financials as carefully as they should. According to a 2019 study by the Brookings Institute,
in 1956, Britain and France invaded Egypt. They had tanks, air support, and the full backing of Israel. Within days, they controlled the Suez Canal. They were winning the war. And then America made a phone call. Not to the Egyptian government, not to the United Nations, to Britain's creditors. Within 48 hours, the British pound was in free fall. The Bank of England was burning through its reserves, and Britain's Prime Minister had no choice but to order a full retreat from a war his military was actually winning. No bombs were dropped on London. No troops invaded British soil. America just threatened to stop supporting Britain's debt. And that was enough to end an empire's last grasp at global power. This wasn't some Cold War anomaly. It was a blueprint. Because somewhere between the end of World War II and today, the nature of control changed. Empires stopped being built with garrison troops and colonial governors. They started being built with interest rates and loan agreements. And if you look closely at the global economy right now, you'll notice something uncomfortable. Dozens of countries are trapped in debt they can never repay. Their central banks hold billions in foreign currency reserves they can't really use. Their policy decisions are influenced by institutions most of their citizens have never heard of. This isn't a conspiracy, it's a system, and it was designed in a hotel in New Hampshire in 1944. The question isn't whether debt is used as a tool of power. The question is how it became so effective that nations would surrender sovereignty without a single shot being fired. Let's rewind to July 1944. World War II is still raging, but the Allies know they're going to win. And they also know the world economy is completely destroyed. So 730 delegates from 44 countries gather at the Mount Washington Hotel in Bretton Woods, New Hampshire. Officially, they're there to create a new international monetary system. In reality, they're there to decide who controls global finance for the next century. Two men dominate the conversation: John Maynard Keynes, representing Britain, and Harry Dexter White, representing the United States. Keynes proposes something radical, a global currency called the Bancor that no single country controls, a system where trade imbalances are penalized, whether you're in surplus or deficit, true economic neutrality. White has a different idea. Make the US dollar the world's reserve currency, peg it to gold, make every other currency pegged to the dollar, and create two new institutions, the International Monetary Fund and the World Bank, to manage it all. Guess which plan won? Britain was broke. The war had cost them everything. They owed the United States more money than their entire economy could generate in years. So when White put forward his plan, Keynes didn't really have leverage to negotiate. The Bretton Woods system passed. The dollar became the global anchor, and the IMF and World Bank were born with a very specific mission: stabilize the global economy and fund post-war reconstruction. At least that's what the brochure said. Here's how it actually worked. Let's say you're a developing country in the 1960s or 70s. You want to build infrastructure, roads, dams, power plants. You don't have the money, so you go to the World Bank or a consortium of Western banks. They're happy to lend. The terms seem reasonable. Low interest rates, long repayment schedules. The loans are in US dollars, but that's fine because the dollar is stable. It's as good as gold, literally. You take the loan, you build the dam. Maybe you hire a Western construction company because that's part of the loan agreement. The dam gets built. Everything's great. Then the global economy shifts. In 1971, Nixon ends the dollar's convertibility to gold. The Bretton Woods system collapses. Currencies start floating. And in the late 70s, the U.S. Federal Reserve, trying to fight inflation, raises interest rates to levels not seen in modern history. Suddenly, your loan just got a lot more expensive. Remember, you borrowed in dollars. Your revenue is in your local currency. The dollar is now worth more. Interest payments that were manageable are now devouring your national budget. You go back to the IMF for help, and this is where the system reveals its actual function. The IMF will restructure your debt. They'll give you more loans to pay off the old loans. But there are conditions. They call them structural adjustment programs. You need to cut government spending, privatize state-owned industries, open your markets to foreign investment, devalue your currency, remove capital controls. You don't have a choice. Without the IMF loan, you default. Your currency collapses. Your economy implodes. So you accept the terms. And quietly, without anyone signing a treaty or a single foreign soldier stepping on your soil, your economic policy is now written in Washington. This isn't theoretical. It's a pattern that's repeated across continents. In the 1980s, Latin America went through what economists politely call the lost decade. Mexico, Brazil, Argentina, all buried under debt they couldn't service, all forced into IMF programs that required slashing social spending and selling national assets to foreign corporations. African nations fared even worse. By the 1990s, countries like Zambia were spending more on debt repayment than on healthcare and education combined. The loans that were supposed to build their economies had become anchors dragging them underwater. And here's the part that should make you uncomfortable. A lot of those loans never actually helped the people. The money would get borrowed by a government, sometimes a dictatorship the West supported for geopolitical reasons. It would go into construction projects that enriched elites or foreign contractors. And when that government inevitably fell or fled, the debt remained. The new government, often democratically elected, would inherit billions in obligations for projects that didn't benefit anyone except the previous regime and its backers. But the IMF didn't care who borrowed the money or what happened to it. The debt was still owed, and the conditions still applied. In 2001, Argentina's economy collapsed after years of following IMF prescriptions to the letter. Unemployment hit 25%. Half the country fell into poverty, all to ensure that German and French banks got repaid. The pattern is always the same. Lend to countries that can't afford it, wait for a crisis, restructure the debt with conditions that transfer control. Now, you might be thinking this is old history, developing world problems from decades past. Except the system didn't go away, it evolved. China's Belt and Road Initiative is the same playbook with different branding. Beijing loans billions to countries in Asia, Africa, and Latin America for infrastructure projects, ports, railways, highways. The terms look generous until they're not. Sri Lanka borrowed heavily from China to build a port in Hambantota. The project didn't generate the revenue promised. Sri Lanka couldn't make payments, so in 2017 they handed over the port to a Chinese company on a 99-year lease. A literal port on sovereign Sri Lankan soil, controlled by a foreign power,
because of debt. Pakistan owes China over $30 billion. Zambia is spending over half its government revenue just servicing Chinese loans. The debt trap isn't a myth, it's a business model. And it's not just China. Right now, dozens of countries are facing debt crises. Lebanon's economy has collapsed. Tunisia is negotiating with the IMF. Pakistan is on its 23rd IMF program. Even developed nations aren't immune. When Italy's government tried to increase spending in 2018, bond markets revolted. The spread on Italian debt spiked, and Italy quietly backed down, not because voters rejected the plan, but because investors did. Debt gives creditors a veto over democracy. Here's the really uncomfortable part. This system requires countries to stay in debt. If developing countries actually paid off their obligations, they'd have control over their own economic policy. They could prioritize local needs over export markets. They could protect industries instead of opening them to foreign competition. The system doesn't want that. It needs debtor nations, because debt isn't just about money owed, it's about leverage. Let's talk about the math that makes this permanent. Developing countries need dollars to trade globally. Oil is priced in dollars. Most commodities are priced in dollars. If you want to import anything, you need dollars. To get dollars, you export goods. But the prices of those goods, commodities mostly, are set by global markets you don't control. When commodities